Welcome to Money on Tap, your personal finance headquarters, where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. And we believe all investments have merit, all investments have relevance, and all investments have their time and place depending on you, your objectives, and your goals. My name is Seth Cressman, and I'm joined here once again with John Ryder and Ben Brayshaw. Good morning, you guys.
Good morning, Mr. Cressman.
Good morning, Seth. How you doing?
Finally, I feel a little respect in the
Or
room.
is it Doctor? Is it Dr. Cressman, or is that your dad? That's your dad, I think.
Okay, moving on. We're all glad you're listening to Money on Tap. And if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap or online at our website, www.moneyontap.com. And today, we're going to be starting to talk about something a little different there, folks. Something a little different.
Yeah. Well, I'm excited about this show today.
I am too. You know what? A lot of times we have clients that come into our office and they say, you know what? I want to explore some different ideas when it comes to investing. And sometimes they have some different ideas when it comes to that. And many times, Ben, in fact, we've had people that come in and will say, you know what? I have some real estate and that's what I want to be doing my investing for. So I'm not going to, get any traditional type of investments, but I'm really want to continue on with the real estate investing and want to keep on doing that and getting income. What do you think about that, Ben? Do you think that's a good idea for me? Is that good for my future?
Yeah, we get a lot of people all over the place about looking for non-correlated assets to the stock market. Boy, that's a lot of words right there.
What does that mean,
Holy
non-correlated?
smokes,
Holy cow. Now you're throwing out the financial jargon.
Yeah, jargon.
Here we go.
So, when it comes to investing, right? I mean, most people are used to the ABCs, right? They're looking at the stocks, the bonds, the mutual funds,
my mutual funds.
Whatever the story is that they walk in with CDs, yeah, all of those different pieces, and then they get hit by the market, and they start saying to themselves, "What do I do to maybe I heard about this or I heard about that," and then you find out that people, because of some event, went out and bought a duplex or a quadplex or a piece of commercial real estate that they have an office space they rent out and so forth.
And maybe the value of that didn't go down when the rest of everything they had went down. Because you could look at, sometimes we'll look at client portfolios, and sometimes we do see them that we'll see a lot of the different areas went down, some maybe more than others. But we'll see, for instance, maybe their large cap fund went down, their mid-cap fund went down, maybe even their bond portfolio went down. But many times when people are looking at something such as real estate, they don't necessarily have to worry about that necessarily going down at the same time.
Well, and if it does, 2008, we had a huge real estate crisis, right?
Sure.
I mean, we had all sorts of things happening, and but they still saw revenue. They still were paying the bills and paying down their mortgage or whatever, and they figured, you know what, I'm in it for the long haul. This thing will become an income generator for me when this mortgage is paid off in 20 years or whatever.
I think there's a lot of people out there, and I actually recently just talked to someone, actually my former landlord from many, many years ago, who I was talking to about investments and all. She called me up out of the blue. This was after 18 years ago.
Was she trying to collect that last month rent?
No, she was, and she was not going to get it from me. She was not going to get it. No, so it's just a wonderful lady who had moved down south, and she called me up and she said, I have this building here that I'm getting rents on every single month, and I love that aspect of it. She said, but you know what? I want to move back to New Hampshire. And as a result, I had to think about, what am I going to do? Am I going to hold on to this asset? And you know what? That was 100% of what she owned as far as assets were concerned. So maybe she would be looking at an alternative investment as a mutual fund or an annuity or that type of thing. Yeah. But really, in reality, what she had was 100% real estate based, and she was basing all of her future income, in addition to Social Security, she was basing all of her future income on the rents that she would receive from that building. But one of the things that she was concerned about that building was the fact that, I might have to put a new roof on it. I might have to do this. I might have to separate this. And so we did talk more about it. And we haven't really come to a final conclusion about what she's going to do, but she really needs to look at diversifying her portfolio in a way that would really help her produce an income later on.
there's a lot of different alternatives that people will look at for investing, right? I mean, and there's all sorts of different things people have heard of, the hedge funds.
Crazy risky stuff. Yeah.
Yeah. They've talked about, a lot of these things are for the super high net worth people, but managed futures and commodities and derivatives. Don't say the word derivatives. Everyone gets scared.
Right.
Right.
Why wouldn't they?
Well, exactly. I mean, there's so many different pieces of investing structures out there that are so far beyond the average investor. And that's not what the show's about.
No, in fact, Seth, we were talking before the show and you were talking about maybe auctioning off one of your baseball cards here for a nice little return. But no, even things like that, some people do count.
That's my whole plan of diversification and non-stock market correlation.
Yeah,
because
Seth's like, I'm very diversified. I have National League, I have American League, I have pre-1940.
He's got the full set of the first Upper Deck series with a Ken Griffey Jr. card, number 1.
So Seth can speak very well to alternatives there. Yes, for sure.
And it's inappropriate because we're in baseball season and the playoffs. So
right.
You know what we're finding interesting too, guys, is the fact that we're seeing a lot of large pension funds, a lot of endowments are starting to look at different alternatives when it comes to investing their dollars. In fact, we actually are going to talk a little bit about Harvard and Yale today, and about kind of some of the different decisions they've made when it comes to investing
which
their
has
dollars.
helped them in their portfolios quite nicely over the last 10, 15 years, and some of the most recognized performance out there. I think the thing is what we want to try to do today, if you're listening to us, is we want to talk about trying to bring this down to the average investor and maybe some areas that you could look at in the market to consider as investments to broaden your portfolio. We're going to talk about basically the 11th sector of the S&P, which is real estate, which I think is really going to be exciting.
There's a lot of different investments that people can consider. Recently I came across an article in National Real Estate Investor. It was written by Beth Madison Teague. This is back in January of 2017. But she talks about how institutional investors, including pension funds, are stepping outside the box beyond the core asset types of office, industrial, retail, and apartments to consider growing menu of alternative real estate options. So there's really a lot of different alternative property types out there that have already exploded in the publicly traded market. And
so there's alternatives within the alternatives.
Yeah. Oh, exactly. Exactly.
It's like the mirror facing the mirror, and it just continues to project down the corridor.
Yeah. There's this guy named Greg McKinnon. He's director of research at the Pension Real Estate Association. He's in Hartford, Connecticut. And he says that right now, the new types of properties they are looking at is just starting to slowly get a grip in the private market as well. He says there's been a noticeable spike in pension fund interest in non-traditional property types over the past few years. He says how much that interest is translating to actual increased investment is still up in the air a little bit. But there's really kind of a big secular shift when it comes to these big institutions as far as where they are placing their dollars for their investors.
Well, I think they're looking at some of the landscape that has existed for these endowments out there and said, hey, maybe we're really playing the market wrong. We have significantly ridden the 10 sectors of the S&P that don't include real estate, and that hasn't really performed for us as well as we wanted to with this 5% yield after the last 15 years.
For sure. There's the CEO of a company called American Assets Capital Advisors. His name is Burl East. He says that investors are continuing to push the boundaries of traditional investments to include a wide range of options. It could be single-family rentals, data centers, workforce housing, land, timber, golf courses, even prisons. So there's a very huge spectrum out there as far as different types of investments that people could consider. But he says this. He says, chief among the factors fueling the demand for alternative real estate is a desire to capture higher returns. Just like you were saying, Ben, there's a bigger hunt for yields. And so they're looking for, hey, how can we make money for our investors out there? And what's the best way in which to do that?
And this is what we have been talking about as a firm for going on 10 years or more, maybe, just going through the demographic shift and how the search for yield is driving the demand of assets.
People are looking for alpha out there. They're looking for that alpha.
Yeah, but they don't want the beta so high. And when we talk about alpha, we talk about yield, and we talk about beta, we talk about risk, and we want the beta low and we want the alpha high.
So here's what we want, Ben. We want all the returns in the world with none of the risk in the world.
No problem, Johnny. No problem. No,
sign me up for that.
Bring back the 15% yield CD, please.
That's right. That's right.
I'd love to be able to.
How many times do we have people come in our office and talk about that? It is unbelievable. It doesn't exist anymore.
I had people talking to me saying, I have one guy, a client of mine, a wonderful guy, who is northern New Hampshire, and he was a treasurer for his church, and he remembers back, when was it, 80s? 80s, where he remembered having a 16% CD, and they had $100,000 for their building committee, and he went across town, moved the money out of that CD, paid a little penalty to do that, to get into a 17.5% rate CD. Where are those days? And that's really what we see. A lot of seniors today are really struggling with. How do they get their income, and how do they go about that?
Well, and that gave the wrong statistics for people. They were taking those numbers and they were trying to apply those forward both on retirement, on investments, all of that. Now we're at a low yield area. But I think what's really, really the battle that people have in front of them is finding the yield inside dividends, finding the yield inside current regular income when they hit retirement. We have 80, 90 million Americans going to be over 65 in the next 20 years on top of the 30 or 40 that are already there. We literally are watching over 10,000 people a day go over 65. And each one of those people want nothing more than income.
That's right. They don't necessarily care about the value of their assets as much. Well, some of them may, but they care mostly about every single month that they're going to have perhaps their pension, perhaps their Social Security coming in, and also income from their investments. They want to make sure that's consistent.
They're not going to outlive those. That's the other piece of that too. Is we want to be able to have that income stream turned on and be able to compensate for the inflation, but never run out of the money or the cash that they need to be able to live.
Absolutely, Seth. In fact, we have a lot of clients out there who do like the safety and security of having their money at the bank. But one of the things they're very concerned about, and one of the things we point out to them, if they're not concerned about it, is the fact that if they are getting 2% on their CD at the bank, that if their cost of living...
That would be a high rate.
That would be a high rate. But if they're getting 2%, let's say 1.5%, if their cost of living is increasing at 3.5% to 4% across the board, there's no way that they can keep pace with that, especially if they're retiring at an earlier age. If they're retiring at age 60 or 58, how do they possibly keep pace with inflation with a low investment rate of return like that on their CD?
Well, it's interesting. We did our show on the basically the vulnerability of pensions a while back, and I had a woman come into my office. They've been clients for years, and she just got a buyout from work and all excited and stuff and going through the pension numbers. And her husband wasn't able to be there, but he called in. We were chatting for a while, and basically he said, I'm really concerned about this pension. We got this small little place having this pension. Though they say they're well-funded, I just don't know who's going to be managing this thing over the next 20 or 30 years. And I would rather take less income and know that I have some sort of large corporation managing it for me instead. It was just an interesting conversation that is becoming more of a mainstream.
Well, we're seeing that in the papers, and I think from our pension show that we did a while back, all over the country we see different corporations, we see different municipalities, different government entities. These are very, very, many of them are very, very underfunded, and that's going to create a problem for people. In fact, it's creating a problem right now for people. You look at Texas, you look at Oregon, you look at even Massachusetts. There's areas there where they're very underfunded.
You brought up something that I think is really interesting, and it's a blessing. And
you were talking about me, Seth, right? I was talking. It was interesting.
Oh yeah, no, it was definitely you.
Ben Bradshaw, right?
You were speaking. It was all you. And what you actually mentioned, though, Ben, is the looking for yield. And in environments where people have been retiring, where there was the 15% CD, and no fault of any advisor during that window to be able to look down in their crystal ball and say, well, that's really not going to stick around. A lot of the planning was done around percentages, like 10%. Well, if we're doing 15, we should be able to do 10% down the road, right? And use that as a kind of a baseline or a minimum to do some planning around. And we're in such a low yield environment now that as planners, we get an opportunity to have, I think, more realistic expectations in plan for lower yield. And then, hopefully it's the under promise over deliver kind of a thing. And we're looking for ways to maximize income. And there's different, the problems or the stresses or in an environment can sometimes create alternative solutions is one of the things that I think we're looking at and talking about here. And we're in a blessed environment to be able to do that and have more realistic expectations, I think, for clients. But the other side of that is recently we've seen the stock market just go crazy. And that's the other side of what we have to deal with sometimes when we're talking about trying to create incomes for people is like, well, the market's done 15% or the market did whatever it did last year. And we will talk about those things, but at the same time, we are not expecting that to continue down the road, and we're not trying to pace that type of return in a portfolio or expect that kind of a return in a portfolio future.
Yeah, I think what people are really looking for is an honest income that they can count on and that they have some sort of personal security. Now, it may not be guaranteed, like when they're looking at these market investment or alternative or whatever they're doing. But at the end of the day, people want to feel confident that, less some sort of major catastrophe or goodness gracious, the guy in North Korea, that psycho, launching a missile or something like that. Everyone knows that, there's these events that will occur. And should they occur, that would cause major market, downturn. And people walk into these investments, whether it's the stock market or a bond or whatever they're buying, with that in the background. I would say I don't really meet a lot of people that don't acknowledge, like, if North Korea launches a missile at some country, whether it's us or somebody else, that we're not going to have a market pullback. People are not naive to that. But they still want some reasonable, general understanding that income's going to come through pretty regularly. And I think that's where, the real estate piece of the marketplace has become very attractive because the yields tend to be a little bit higher because there's active income usually going through them. It is higher risk, even in the stock market side of this, because real estate is high risk. But those are things that, people are now really starting to become aware of and start questioning.
Absolutely.
You're listening to Money on Tap. We're going to take a quick break and be right back. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Hi, my name is Seth Crustman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Find out more about three-dimensional investing, utilizing insurance, brokerage, and fee-based planning with Ben Brayshaw, Seth Crustman, and John Ryder on their weekly radio program, Money on Tap. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group are independent of SagePoint Financial.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. Today, we are talking about how to get outside of some of that investor mentality or some of the market correlation. Basically, if you're looking at an S&P index or if you're looking at the Dow Jones index, and that's kind of what the market is, how during a downturn, or how do you get outside of that step-by-step correlation with your investments? And there's lots of ways to do that, folks. I own baseball cards. And it's not a recommendation because they are not worth a thing, in case you're wondering. But that could be outside of the market and considered an investment for all intents and purposes. So what is it in a portfolio that can continue to drive income or can continue to sustain the ability to potentially not rise when possibly the market is going down and support a portfolio long term? Well, those are outside of the market typically types of correlations and in the investments. You can possibly buy or trade those on the market very readily and easily and available for the entire public, but some of those might not be available to the entire public because of certain limitations. So anyways, that's what we're talking about here today, folks. And one of the things I think that's interesting is the investment and the correlation with emotions. And I think if you're able to possibly, let's say, take your portfolio and just lock it away for 5-10 years and not have to even think about it, that could possibly get you out of that buy-sell investor euphoria that a lot of investors do not experience the returns of whatever they might have had in their market, because the average investor, let's face it, folks, is at about 2.5%. When you have stocks that on average have yielded around 9.5%, bonds at 6%, other investments, gold, international stocks, you name it, have done quite a lot better than the average investor at 2.5%. And a lot of that has to do with that investing and the emotional roller coaster that the investor can be on.
Yeah, that's a great, wow, good lead in, Seth. I like that a lot. When thinking about and talking about the income side of this world, I think one of the things that you can really drive from that is that emotion will cause people to take action on their own funds much faster than we would. We look at the much bigger picture, right? So we're going to say, hey, listen, we're through this market swing or that market swing. And when you're looking at income, and something's providing for your income, if the market's going up and down, and that's what's happened, but the income is stable, or the dividends are coming through consistently. That was one thing that happened to GE many years, a number of years ago during the financial crisis. They turned their dividend way down. I think they even turned it off for a short stint. And that was a scary thing for people because GE was
They were relying on those dividends.
Yeah, people had owned GE for all those years because they were so consistent with the dividends. But
it was a hallmark of that type of an investment, really, was that they had kept it on and been consistent and it was dependable for as long as people could remember.
Right, exactly. And so that was a big issue for people pretty heavily inside owning GE was, the dividend side of it. Now, when you have that dividend income, I think what makes this really interesting is because, the biggest fear is what we call compounded loss. We talk about this with clients all the time.
Sure.
Right? So if you have 100% of your money and it goes down by 10%, okay, you're down to 90% of your money. But then if you take 10% of that out for income, well, that's 9% of 90. That brings you down to 81%. It takes you about 24% to get back to square one. So that means you have to outperform the 10% market loss above and beyond your income, right? You had a 10%. Market only went down 10%. You got to create 240%.
Compounding losses can kill you.
They can kill you. And so what's nice about strong dividend income producing assets is that you can continue to collect your income, okay, or dividends, whatever they're paying out, while you watch that market kind of ride the road that it has to ride. And that's where people like that's where the attraction to the real estate sector inside the stock market is becoming more and more appealing to people because the dividends, again, tend to be a little bit, nicer and higher, but not all the time. But there's a lot more risk to it. And that's, you don't want to overweight in a sector entirely, but that's something that, people are like, well, if I own this and it's creating current income, it went down 10%. Who cares? I'm just living off this income. I'm not going to be depleting the principal. I'm just taking the income off of that. So that's a different way of investing, is just getting something that actually, creates that income, pushes that money to you as the investor. And that's something that I think people don't understand, is that compounded loss, John.
I think you're exactly right, Ben. Let's turn the tables a little bit here.
Can you repeat that? I just want to record it.
I said you were right. It's very rare. It's very rare, Ben. Now, there's an article by Michael Bradburn, and I want to switch just gears here a little bit in talking about the Ivy Leagues and kind of what they consider. But this is kind of an interesting article, I think, that is entitled Ivy League Endowment, Yale Leads the Way with Alternative Investments. And Michael Bradburn writes back in September of 17, it was collegiate sports, and specifically the need for rules in football, that brought the 8 colleges together in 1873 to form the Ivy League.
It's football that brings us together, folks.
Well, the thing is with Ivy League, the competition obviously has always been intense. But I will say that it's not only been intense for sports and for education, but it's also, as of late, become much more intense when it comes to their endowments. And it says this here. It says the University Endowment, which was also born in the Ivy Leagues, is an interesting study of both investment strategy and performance. And for those of us who follow investment and registered investment advisor trends, the fact that the Ivy League colleges publish their endowment fund performance data makes for very interesting reading. And for 2016, the Yale Endowment takes honors for the best performance in the Ivy League. And so Mr. Bradburn here talks about Yale's dominance is really according to 3 factors. And those 3 factors are this: a focus on alternatives, strong emphasis on asset allocation, including negligible exposure to commodities and commodity-related markets, and positive returns arising from manager selection. So credit is given to the Yale Endowment manager, David Swensen, in a strong emphasis on alternative assets. But it says this, too. It goes on to say this: not all the Ivy League schools fared well in the year 2016. By comparison, Harvard experienced a $2 billion decline. What seems to separate Yale from other Ivy League schools is, as MPI calls it, an overweighting of private investments, including hedge funds, private equity, venture capital, and real estate. Yale had an 11% exposure to public investments compared to a 20% exposure for Harvard. So Yale benefited because its exposure were balanced among private investments relative to their peers, thanks to greater exposure to private equity and real estate than to hedge funds and venture capital. Within Yale's substantially small exposure to public markets, it overweighted U.S. equity and bonds relative to commodities and emerging market equities. So it's saying there's a lot of endowments out there that invested crazily aggressively in hedge funds, that type of thing. Didn't turn out so well for them.
Yeah, no, they took the real estate approach. I think the one thing that we need to kind of crisscross here is when we talked a little bit about the high risk inside the real estate world. That's an apparent obvious, and
sure.
Even your home is high risk. I mean, if all of a sudden someone discovers some nasty chemical underneath the ground,
termite infestation, whatever it may be,
it's high risk. But the illiquidity of real estate, even in the stock side of the real estate world, the underlying assets are highly illiquid. Okay, they can have an open market but it's not an open market like, hey, people are just making bids on these properties. You put it out for sale like any piece of commercial real estate.
That's a great point. I bought my house in 2004 here in New Hampshire, and right after I bought it, the house had done nothing but skyrocket in value. So I bought it at a very high time in the market. As soon as I bought that house, I noticed that the values were going down around the area. It's a nice area and everything in New Hampshire. However, the values were going down, and it's taken many, many years for it to actually come back up. So the fact is, if I had bought my house and if I needed to sell that next year, I would have taken a significant loss on that. A significant loss.
And the illiquidity of real estate, though, a stock that is traded real estate,
yep.
Okay, and though that has an open market and it's truly liquid for you or whoever owns it, the underlying asset, though, the illiquidity of that does weigh down on a stock. And I think people need to even know that even though you have an open market and you can trade it instantly within seconds, you need to still understand what you're owning and the illiquid nature of it underneath, because that can hamper it. If they know that they have an asset that is they're own some of these programs. I mean, they're billions and not millions, billions, as in boy, assets, huge stocks that if they find one property that's, $50, $100 million asset in their portfolio, and it turns out that it's on a bad piece of land and there's a problem, that could be a complete zero inside the portfolio overnight. And all of a sudden, you can sell it, but you're going to take an instant hit. And those are things that are unforeseen and potentially income loss. So that's where the dividend yield, it's something to be careful of. And I think, just because it's real estate and so forth, you're not going to, there's no guarantee anything in the stock market. But, I always tell people, listen, if you're going to invest in things like this, now Yale, Harvard, I mean, they're all about how big they can get their endowment more so than what they can do with it, in my opinion.
They don't care about liquidity in their investment at all.
Yeah, they can write out just about any scenario and tone down this or tone down that. I mean, I was looking at one of the articles here, and I mean, they have the College and University Business, National Association of College and University Business, listing that the college and over 50% in alternative strategies. That could be traded, untraded. That could be all sorts of different types of things. That could be hedge funds, private. Who knows what they're doing underneath that? But it's amazing. It's amazing that only not over the last X number of years, not more than 5% in cash or other short-term securities.
Yeah, they're just not getting the returns in those.
Yeah,
areas.
so they're really overweighted. But I think it's funny that the article, John, you have here mentions that diversification, that they emphasize a strong relationship to diversification. And meanwhile, you get another report that says that they get over 50% in alternative strategies.
KKR, that's a global firm that talks about the evidence of the migration from people going to traditional, or institutions going from traditional to alternative type investments. It shows that they did a survey of high net worth and ultra high net worth investors. The survey showed allocations to alternative type investments to 22% to 45% of invested assets. And it goes on to say this: indeed, for investors and advisors that understand there's a distinct difference between market risk and illiquidity risk, alternatives can offer returns that even an efficiently priced private security is unlikely to achieve. Now, this may or may not be an appropriate thing typically for a private investor, but what we're talking about here is the fact that these large companies, large endowments, large pensions are seeing some value in that alternative space.
Seth, going back to one of the comments you made, which was, looking at, when you talk about international assets, when you look at that, the numbers that Seth was reporting versus the 2.5% average investor and the emotional swings, you could own some of these, you could have thrown all your money in international, beaten your own, and just said forget it. But honestly, if your emotional swing took over in that, you would have taken a real bath. But it's interesting to know that the average investor isn't even competing with some of the lowest return areas that we have in the market.
Exactly. Ben, you mentioned emotions. And I think emotions is something that we deal with a lot as advisors when we're talking with people. We have a great piece that is sitting in front of us here that is talking about the cycle of investor emotions, because there's all different, and we see this when people come in, there's all different types of things that people have when it comes to investing and types of emotions that they have. It starts out with optimism. Maybe they're very excited. There's a thrill. There's this euphoria of investing. But then all of a sudden, if they see their investments go down, there might be an anxiety. And all of a sudden, it's kind of like a denial. Oh, no. And all of a sudden, there's fear. What's going to happen? Then there's desperation. There's panic. There could be capitulation, despondency, depression. And then all of a sudden, hope, because they see their investment maybe coming back. Then there's some relief that, oh, okay, so this is not the worst thing in the world. And then it's back to optimism again. So there's kind of this up and down emotion that investors face. And I think many times when investors are spending too much time getting and trapped in those emotions, that can be a problem with investors.
John, I think you just described my morning.
Okay. Optimism to start out with, then depression.
You're listening to Money on Tap. We're going to take a quick break. And right after this, we'll get back. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
John Ryder looks at the advantage of the Roth IRA over the traditional IRA, while Ben Brayshaw warns of the possibility of a federal sales tax on this Cliff Notes edition of Money on Tap.
If I gave you a present, Seth, and I said I gave you $100,000 in a traditional IRA, and I gave Ben $100,000 in a Roth IRA,
he likes me.
Yes, he does.
You could tell that I would like Ben better, because that Roth IRA, if you think about it, if you're at 65 years old, which these guys are getting there, but they're not there yet. But if you're at 65 years old and you have $100,000 in a Roth IRA, and you have $100,000 in a traditional IRA, think about this. When you start pulling the money out of that traditional IRA, you're going to pay taxes coming out at your tax bracket. But with that Roth IRA, every dollar you pull out, you pay no taxes on. So huge advantage.
I think my concern for the people who are what we call 401k or IRA poor, and what we mean by that is that they have a ton of money and pre-tax retirement plans in which they're going to be subject to every penny of retirement being taxed when they pull out. My concern is, as the Roth and the after-tax investment world continues to grow, because people start realizing that tax rates are lower right now, that we may end up seeing a federal sales tax.
Sure.
That would be able to...
Every time we spend money.
Right. Every time we spend money, we would actually get taxed on a federal level because all that Roth money will not be taxable. Now, for the traditional IRA and the 401k investor, okay...
That's double taxation.
That's double taxation.
Yeah.
Right? So that would be interesting, because how would the government be able to distinguish how you got that money into your account? So it's interesting. So I think, getting as much out of taxes now may be wise, considering the fact that we have $20 trillion in debt as a country, and there's only two ways to pay for it, and that's either to reduce our spending or increase the income in our government, and that's through taxation.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at www.yourmoneyontap.com. And folks, if you have a show idea, if you have a concept, if you have something that you would like us to bring to light, maybe pull back, take a look under the hood at, one of the things we love to do is give you either a hat or a T-shirt, your choice on any of that swag that we've got here at Money on Tap, and send that your way just for sending us a show idea or something that you want us to talk about here on air. It's our appreciation for you. We're glad you're listening. And today we are talking about some different things in portfolios that sometimes might make a difference in your long-term investment. I mean, that was super vague there, folks. But what we've been talking about is Harvard and Yale and these endowments, and what are some of the things that they're doing for their portfolios to get returns in a really a sizable fashion in most of those cases. Yale would be the one that we'd love to try to follow suit with, where they've done quite well. Harvard, not so much, because they invested a little differently. And believe it or not, I think some heads were rolling on those returns just because of the oversight on those was not what they were looking for in that Harvard return.
Yeah, no, I think it's funny that you get all this diversification notions inside all these endowment programs, and as we mentioned earlier, it's like they're actually not really diversified very well.
Well, it's diversification within that class even sometimes. Like we're talking about real estate, but how many other categories are there within that alt class of investments out there?
Yeah, there's so many different pieces. I think what I really like about what we're talking about today is, there's this kind of like, it's this world where, the super wealthy invest, and that's, where the Harvard and the Yales and they've got other things they can reach into, right, to create diversification and offset and hedge funds and whatever they're using, right? But the average investor is trying to find how to find, that breadth inside their portfolio, right? And the fact that there are some, traded real estate assets out there, there are some traded alternative assets out there that they can look to for income yields and so forth. I mean, it's not an area you're going to go high in percentage if it's at all appropriate for you. I mean, you have to understand whether it is or isn't. But, the fact that you can create some diversification inside that, and maybe look for some dividend yields inside real estate, because not everyone wants to own the duplex or the quadplex. I mean, how many times have we dealt with people? There was an attorney down in New York City I talked to, who was 85 years old, retired, who had this duplex, Manhattan, didn't want to own it anymore.
They're done with the sticks and the bricks. That's what it is.
It's like they don't want the hassle, but they love the income.
Yes.
They love the income. And those are the types of things. So people, not everyone's cut out to really own real estate, manage it, and deal with the hot, the water pipes bursting and the hot water tank broke and the the phone calls at 12 or 2 in the morning, the heat's down, whatever the story might be that I'm sure we're talking to, people are listening saying, wow, that was me and I got rid of that thing, I couldn't stand it. Well, I mean, you can do research, you can find things that are real estate focused inside the stock market that might get you similar or generally the same type of allocations inside that. I think what's really interesting is that inside real estate, there are so many different classifications of real estate. Now, this is where I find it exciting, because there's a lot of foreshadowing inside the demographic studies that we have done and we've read about and talked about and so forth. I mean, you've got industrial real estate, you've got commercial real estate, you've got healthcare real estate, you got data centers, you've got...
That's an interesting one right there, that data center one I found fascinating.
Yeah, I mean, there's so many different classifications in areas that are growing and how they're converting certain properties to do X, Y, and Z and what these companies have done. I mean, and they're growing. I love the healthcare real estate story. I mean, with the demographic piece and the demand for healthcare and the ongoing growing demand at an exponential rate, in my opinion, that is something that I think, you've got some good opportunity for stability with the right management company behind you. And that's where I would say, but you don't want to put all your money in healthcare real estate, right? I mean, we're talking small droplets, limited exposure inside the stuff. But this is something that people are calling us about. These are things, I mean, John, you had an older woman who wanted to talk about real estate. I mean, you met with her and all she wanted to talk about was real estate. And, she wanted to sell her piece of real estate, still wanted to own real estate, wanted to, divest of the management and the ownership because it was too far away and those types of things. I mean, we have people looking for answers in this area. And I think this is the driver of this show today is trying to reach people and say, listen, you don't just have to buy XYZ stocks. You don't have to buy XYZ mutual funds. There are other options, and you can still get into the stock market and do this, and you're still going to be vulnerable inside the stock market. But you know what? If you want to get that exposure, there are options.
I love how this is a way that everybody can be involved. I think as one of the things that hopefully we get an opportunity to communicate with you as a listener is that, we are not a firm that has just set ourselves aside specifically for the investor that has 10 million to 5 million. Believe me, if that's you out there today, we appreciate you listening, and certainly that's one of the things that we do at Brayshaw Financial is a lot of the planning around personal endowments might be kind of one of those things that you might be interested in, and you're hearing some of the things that we're talking about today. But we also want to let people know that we're here for the average person. The majority of the people that we talk to are really in that I got a 401k situation, I've got my house, and I might be considering getting a rental, or I might be trying to do some different side hustles to get some goals accomplished. And you know what? I love the people that come in and they have the budget and they've got the actionables, the things that they can control that they've started to work through, and they're looking for ideas of how to be suitable in an investment environment, or how to accomplish some of their goals inside of a market or another strategy that we might be able to outline. And one of the things that we like to take a look at is how can we get outside of just those market returns or those expectations of like an S&P 500 index or a Dow Jones index or some of those common threads in the marketplace. In the sector that we've been talking about is in that alternative sector, and that can be inside the marketplace, and that can be held by every investor that's out there that's suitable for.
Yeah, I think the thing is you go into these types of programs, okay, these stocks, and real estate focused, you need to be in it for the long haul. This would be a long-term investment that you would be comfortable with what yield you expect from it.
Certainly more aggressive too, Ben.
Yeah, certainly more aggressive. But, it would be something where you weren't entirely dependent on that income either. This would be like I'm going to go on a vacation with type income. Because, when it comes to real estate, if you're ever dependent on that money, you never know what's going to be the underlying problem that's going to drain that dollar from every ounce of income from it.
That's exactly right. And Ben, in fact, a lot of people that we talk to when it comes to some of this, higher risk, it's a very small portion of their portfolio, but it may be money that they're not even going to be using themselves.
Yeah.
It may be for their kids. It may be for their grandkids. I've had clients that are elderly who are in their 80s who have perhaps an aggressive risk tolerance for a small portion of their portfolio, never thinking that they're ever going to pull a dime from that. Is totally for their grandkids, not even for their kids.
Yeah.
But they've set it up that they want this account for their grandkids, and they're okay with having a small portion of their money more aggressively.
Yeah, we've
invested.
used we when it comes to some of the charitable trust work that we do. I mean, diversification, real diversification beyond the S&P 500.
Yeah, we've done a lot of that this year.
I mean, you have to go farther beyond a lot of these things to really kind of deal with distributions and preservation and all the things that charitable trusts have to deal with. And that's the part that a lot of people are just not aware of. They're really, unfortunately, undereducated by their 401k provider. I mean, that most of the time I meet people, the vast majority of the time, if you're listening to this, you're probably this will resonate with you a little bit, but you don't spend a lot of time with your 401k provider. You have an 800 phone call to call into somebody, and you hope to get the same person. You hope to get their extension number. Depending on the provider, they may have a dedicated team of 20 people to those 5 companies or something. But at the end of the day, you're out in the middle of the ocean with a small sailboat, I feel like, and you're tossed to and fro. And, people feel so vulnerable in that state. And they're just like, well, this is what I'm going to buy and this is what I'm going to do. And that's a scary place to be for a lot of people. And I think when they come and meet with us, and they start talking about how to manage that and the concerns they have and the goals they have, the pieces that they want to put together when they have some help, I mean, that's just the next step inside, real planning. It doesn't have to be the way it is.
Yeah, there needs to be a real game plan when it comes to this. And, we've often mentioned this, and Seth, I know I've talked with you about this in the past, but the fact is sometimes people spend more time planning a big trip that they have coming up. I might compare that to a Disney trip. In fact, I think, Ben, you have a Disney trip coming up. But people spend more time.
No, I did that Disney trip. We're not doing Disney again.
But typically people will spend more time planning a big event in their life and not preparing for the big event in their life. That's as far as when they retire and when they actually call it quits from their job. And so there needs to be some forward-facing plan that totally takes a look at where people are today and where they're going to be in the future. And there needs to be an income distribution plan. Once they've done a great job of saving over the years, they now need to have a plan as far as how they are going to distribute those assets over time and how they're going to do that in the most efficient way possible.
One of the and this is one of the areas that I think is really interesting is, as we see like the energy sector developing, there's been a lot of movement, and I think successful movement, in my opinion, inside the alternative energy, inside solar and inside wind,
Sure.
to the point where they're actually starting to become financially viable, in my opinion, where they're actually starting to perform and make money, where the infrastructure to begin with and, some of the upfront costs were so laborsome to some of these programs that it was really difficult for them to work well. But it's interesting to see where that alternative space is also an income generator inside the energy space, as well as separate from just looking at, oil companies and gas companies and things like that, which a lot of people look to, Exxon, been around for a very, very long time. And people look for that kind of, big blue chip company with a big blue chip like dividend,
right.
And so there's some other alternative spaces that you can get into in the energy sector, it's stocks, mutual fund companies that you can, that focus on that can do a really good job. And those are things that I think people are becoming more and more interested in, because I think the community is getting communicated well to that. Hey, this windmill that we've put up, essentially, these wind towers, they're actually profitable. We can actually start making money from them. Before it was kind of like, hey, testing, can we make this thing?
The cost to put those in.
Oh, millions of dollars.
Yes.
I mean, it was just huge money, and to even break even took for a very, very long time. And then the care and the handling of them. So alternatives aren't just real estate, and we're not really just trying to focus on that, but that is pretty much the most popular question we have, which has to do with a woman that we met with.
I think we're just seeing things change so much. You talked about the solar industry, Ben. you take a look at solar panels. Solar panels very soon, I think, are going to be, for residential houses, are going to be more of a thing of the past. If you look at kind of what's changing now, just in the last couple of years, so solar panels were a big deal to put on your house. Nowadays, they're coming out with, this is due to Elon Musk and his entrepreneurship and his ability to see the future. Yes, his rocket. But
people are putting rocket pads on their houses. Am I right?
No,
Did I get that right?
Close. Oh. Well, that may be the future. They're going to put rocket pads off of their Airbnb rentals that they have. No, I don't know. But the fact is, with solar panels, it's been very revolutionary. But what's going on right now is that rather than solar panels, what these guys are selling, they're selling shingles that have that solar capability. In fact, they have the capability to have so much energy from these actual shingles that they're putting on the roof that only 1 in every 9 shingle that goes on your house will actually be a solar panel or have solar capabilities. And so the fact is they're drawing so much energy from the sun. It's just a whole different deal.
So you and I need to talk, man. We haven't even talked about that, but you know what? We're going to take a quick break, folks. We'll be right back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Find out more about three-dimensional investing, utilizing insurance, brokerage, and fee-based planning with Ben Brayshaw, Seth Crossman, and John Ryder on their weekly radio program, Money on Tap. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group are independent of SagePoint Financial.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at www.yourmoneyontap.com or Facebook, folks. We always love the likes and the listens there. Today, guess what? We're talking about real estate, private equity, private loans, commodities, managed futures, energy.
We're talking about
you
it all.
name it. We're in it. John's talking about putting
solar
rockets
panels,
on your. Oh no, solar panels. I thought you were putting rocket launchers on people's houses for energy or something like that. That was just me. That was my.
Well, I appreciate your joke, Seth. I appreciate your joke. You know, I think to close this out, as we kind of finish, our conversation about, finding alternative investments in the stock market and, really breaking down the different pieces that are available. I think what we have seen, and this is not necessarily a trend for, this is what you should do, but I would say that, in the last 15, years or so, the trend for alternative investments has just skyrocketed.
Yeah, as far as what?
I mean, so when we're talking about this, if you're hearing this for the first time, or you're sitting on the other end of this thing listening to it and saying, yeah, I own a real estate, or I own this, or I own that, or whatever, the actual concept is so commonplace now that there's actually rumor that they're not going to call certain sectors part of the alternative world. Like just because it's become such a large piece of the marketplace.
Component of it, yeah.
Yeah, in 2004, it was they say it was about $2.5 trillion.
Oh, for U.S. assets.
Yeah, $2.5 trillion. And then Seth, it's expected in 2012, it was already $6.4 trillion.
Wow. Wow, so more than tripled.
And then it's projected on a growth ratio at 2020. So 2020, we're looking at 13 trillion.
Folks, I think that's going to do it for us here. You've been listening to Money on Tap. Ben, John, really enjoyed the topic.
Absolutely.
Thanks, Seth. Great day.
Take care, folks. We'll see you soon.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.